And so I think right now what you see in the economy is lots of distortion of numbers, lots of distortion of metrics. Right. The fact that we have a debate over whether we are in a recession or not is kind of laughable, right? Because we've been in a recession for 24 months. If you were measuring the production of goods and services, all you got to do is look at the variety of things that were available to you in January of 2020 versus the variety of things available to you today and the delays. If you've got 1/10 the selection and it takes 3 times as long to get it and it costs 20% more, how are you not in a recession? Last year, what you've got is a drawdown of all financial assets. So the NASDAQ is down about 22% over the past year. And so NASDAQ represents tech companies and all the risk assets. But on the other hand, if you were to go and look at like the bond market and the bond portfolios, bonds are down, like the BOND index, the long bond index, it's down almost 17% in the year. So for 30 or 40 years, you had this 60-40 bond portfolio, and the idea was
bonds were considered a safe space.
The idea was if stocks work, then bonds will be a low return and stocks will be a high return. But if stocks trade down, people will shift their money to bonds, and the interest rates will go down, the bonds prices will go up, and you'll actually get a yield on your bond portfolio. But of course, that broke around March of 2020. And the reason it broke in March of 2020 is because interest rates got pegged to zero. So after we had lowered interest rates from 5%, 5.5% to 5 to 4.5 to 4 to 3.5 to 3 to 2.5 to 2 to 0, and left it at zero, then the debate was, can they take interest rates negative? If you can't take interest rates negative, then bonds don't act as a hedge to stocks anymore. I mean, you're at the end of the road for bonds. And what we saw with stocks is the Federal Reserve printed a bunch of money, pegged interest rates at zero, and then you saw all these risk assets explode. You saw the NASDAQ explode up and the S&P explode up. You had a K-shaped recovery. And in the K-shaped recovery, it's almost like the entire economy was in a train wreck or in a car wreck, and we got taken into the hospital and they pumped us full of morphine. And if you've ever been in a bad accident and then first you're in pain, and then they pump you full of painkillers, and then you actually feel pretty good. And you're sitting there and your arm is broken, but you're high on morphine or high on something, and you feel pretty good about it. And you're thinking, why don't I just go break my arm and do this all the time? And then at some point, there's part of your brain that says, I'm going to come home from the hospital and I'm going to get off this painkiller, and I'm going to be in great pain for the next 3 months or 6 months or whatever it is. I think what happened here is the Fed just pumped tons and tons of liquidity, and we stayed high for about a year and a half. And I remember when Jerome Powell said, "I'm not even thinking about raising interest rates," and and said strongly that it'll be till 2024 before interest rates start coming up again. But here we are in 2022. And now instead of raising them a quarter point, each time, now they're raising them 75 basis points. So they're taking 3 steps at a time, multiple times. So we took the cost of money down faster than any time in history. And now we're jacking up the cost of money faster than any time in history. And the result is that all the traditional models are broken. Let me give you a 2-year postmortem since we started dealing with this issue. MicroStrategy had a $500 million of cash, and we saw interest rates at zero, and we saw the stock market inflated in the summer of 2020. And we said, well, what are we going to invest in? And we looked around at everything. Should I buy gold? Should I buy land? Should I buy art? Should I buy some crypto asset? And what's going to happen next? So what we did is we decided to buy Bitcoin, and we bought $250 million of Bitcoin August 10th, 2020. And then around September 10th or so of 2020, we bought another $175 million of Bitcoin or something like that. And then we started buying Bitcoin more in December, and we kept buying Bitcoin. We ended up buying nearly $4 billion, $3.97 billion of Bitcoin over that time period. And declares a war. They basically put public policy initiatives ahead of the interest of the free market. Right. So if I declare a war, I could just draft every single adult in the country, put them in the military, send them off. And if I lose the war, they're all dead. Right. What's it do to the economy? The economy crashes. Right. What's it do to the prices? Well, price of everything go up. If you want to create inflation, you do it a couple of ways. Either you cut the supply, or you cut the supply of the product you want to buy, or you increase the supply of the money that's available to buy it with. So if I make it illegal to manufacture food, the price of food's going up. Right? I don't even need to print more money. Right? I can create inflation just in a war, like in World War II. We have gas rationing. You have food coupons. Why? Because all the gasoline gets shipped off to Europe to put in tanks or to put in airplanes or put in ships. So when you have policies that are declaring a war on something, you divert resources. So we had a war on COVID. We have a war on carbon, an energy war. If I decide I don't want you to burn coal or oil, then I drive up the price of energy. If I decide I don't want you to show up in your office, I drive up the price of production. If I decide that I want to fight this COVID war, and I'm going to change the way the economy works, then I'm going to drive up the cost of everything else. So we've got lots and lots of wars. Right? You've got a culture war. You've got a war on office work. You've got a war on carbon. You've got a war in the Ukraine. The war in the Ukraine has escalated, right? It's not just a war in the Ukraine. It's really a kind of a quasi-economic war on Russia.